our view is that right now is a great time to be invested in innovative, impactful companies that are driving positive change. And I'll explain to you why we think this at the moment. We think that a lot of the macroeconomic variables are coming together, creating the perfect environment for a strategy like ours. So in terms of macro conditions, the most, I guess, talked about factor or variable has been inflation and interest rates. And as many of you might remember, back in 2022, there was a lot of talk about elevated inflation continuing into the future, and perhaps there's a debate about hyperinflation and that being sustained. Our view has always been that those trends were going to be temporary, and over the long term, we're going to see declining inflation rates, and an investment style like ours would come back in favor. And that's exactly what's happened. If we look back to 2022, the reason why we thought that that was temporary was because a lot of the factors that drove up that high inflation, we saw to be temporary. So things like supply chain disruption, the fiscal stimulus, the high prices of commodities, the incredibly high goods demand, labor shortages was another one. These were all COVID-19 pandemic-related issues that we felt would mean revert in the fullness of time. Under those conditions, investors were best placed to invest in low-quality cyclical companies that were not necessarily driving positive change. There was enough high nominal GDP growth and inflation to sustain returns in some of those lower quality cyclical companies. But our view was always that over the long term, these trends of declining birth rates, an aging population, high debt levels, and technological progress and increasing inequality would drive nominal GDP growth rates lower and inflation rates as well. Back then, it was hard to see what exactly technological progress would be. But of course, today, with ChatGPT and AI front of mind for everyone, we can see the productivity gains to come from that technology and to drive down nominal GDP and inflation through productivity. Under those conditions, we believe that investing in innovative growth companies taking market share is the right way to invest, and that is exactly what we are doing. So let's have a look at where inflation is going. Back in 2022, you can see that inflation hit a peak of 7%, and this is US core CPI. And since then, it's been gradually coming down. But the really interesting thing, we think, is that the median inflation number is now back to below COVID levels. And it's only a handful of CPI lines that's holding up that overall number. And our view is that those handful of outliers are finally coming down, so we are going to see a lower overall CPI number in the months and quarters ahead. What are those handful of items that's holding up inflation? Well, it's shelter and motor vehicle insurance. They're the two line items that's really been holding up the overall CPI numbers. But in more recent months, we're finally seeing those items break down. So if we then look out into the coming months and quarters, our view is that the overall CPI is going to trend lower, making it easier for the Federal Reserve to cut interest rates. And that then has implications for investing. So the Federal Reserve's got a 2% inflation target. The overall inflation at the moment is over 3%. But if we look at the last 3 months, we're annualizing at just under 2%. So that suggests to me that we're already at that 2% target. And if we can see those two line items of auto insurance and shelter coming down finally, then that overall inflation number can trend much lower. So what does that mean? We expect, or the market expects, the Fed to cut the interest rate twice this year. And our view is that when they do that, the bull market that we've seen, or the strong equity market that we've seen, will start to broaden. And as I'm sure everyone knows, although the US market has been strong, it's been driven by a lot of the technology companies and not necessarily the other companies listed on the market. And of course, as sustainable investment manager, a sustainable investment fund, we're focused on areas like renewable energy, healthcare, and the like. So, some of those investments have lagged the market for us, but our view is that that is going to turn in the coming months and quarters. I also want to raise here that we are seeing some weakening in the U.S. economy, and our view is that a weaker U.S. economy is actually good for equity markets, and that's because it gives the Federal Reserve more of a green light to start cutting interest rates. But the data that we're seeing out of the U.S. is definitely showing a slowing of the U.S. economy, but it's not breaking, it's not crashing. So, which is a great environment for equity markets. The last data point on employment, for example, showed that unemployment rate actually increased to 4.1%. So, the employment market is slowing, but it's not crashing, which is good. As I said, the probability of a rate cut is, as of a couple of weeks ago, is at 99%. So it's near certain that the Federal Reserve is going to cut interest rates, and that's going to have ramifications for the market. We believe that as the Federal Reserve cuts interest rates, we believe that that's going to be good for impactful investing, for markets that are in sustainable areas. So one area is in electric vehicles. These are quite simple rationales, but when we had high interest rates, it impacted affordability for cars. So, a couple of years ago, when interest rates started going up, and given most people buy cars through finance, it really affected their affordability. And it also came at a time when we're in the midst of supply chain issues coming out of COVID. And that meant that car prices were really, really high. So we're at this intersection where car prices were really, really high, and interest rates were really, really high as well, which then had a double impact on affordability. Now, as interest rates start to reverse lower, affordability starts improving. And also, as supply chains ease, the price of cars is also starting to fall. And we're seeing that in that CPI data coming out. So I said before that auto insurance is starting to fall. Well, auto insurance prices is only starting to fall because car prices are starting to fall. So we expect car affordability or auto affordability to improve, and more specifically, electric vehicle affordability to improve in the quarters and years ahead. Another area that we think that will benefit as interest rates come down is in the fintech space. So, here's an industry or sector that really suffered as a result of high interest rates because people were concerned about the credit quality as interest rates increased. Now, as interest rates decrease, we expect the credit quality and concerns to alleviate. And so companies like Mercado Libre and Nubank, which are delivering financial services through technology in Latin America and driving economic growth to many of the population that don't have access to financial services, we believe that they're the types of companies that are going to do well in the coming months and quarters and years. Another area that we're really excited about is in renewable energy. So again, as interest rates increased, these are very capital intensive industries. And so as interest rates increased, it impacted projects negatively, and a lot of the stock prices were affected accordingly. So, and on top of that, you had a lot of supply chain issues coming through, which then meant that the development cost of many of these projects far exceeded the initial estimates. and the profitability of these developments were compromised. And so a company like Ørsted, for example, is down 60 or so percent from its peak a couple of years ago. So we think that as interest rates start to decline, companies like Ørsted will start to improve in the quarters and years ahead.